The responsibility of the guarantor is to pay for someone else's loan if that person cannot afford to repay. So the guarantor is usually a family member, a friend, a spouse, or a colleague who therefore agrees to cover the cost of the loan if that borrower does not meet repayments at the end of the month. Now, we appreciate the circumstances can change. Maybe the borrower can't meet repayments because they got paid late from work, or another emergency came up and they couldn't meet the payments on the date specified. But as the guarantor, you will be obligated to make the monthly repayment as per the loan agreement which you would have signed prior to the funds being transferred. So, as a guarantor, there are things that you need to be aware of either before the application or during the loan is underway. For instance, it is important to have the money available in your account, because if that borrower defaults, then the lender will instantly go to the guarantor's account and try to collect the funds. So it is important that not only the borrower but also the guarantor have the money available in their debit account for collection. This is because if collection cannot be made, then there could be added late fees and charges. The guarantor lenders we feature work on a daily interest, so the longer that you haven't repaid your loan, you may be, if it's 5 days longer that you haven't repaid for, then you will be charged an extra 5 days worth of interest. Now, if you don't repay, it will unfortunately negatively impact your credit score. The way it works is that the guarantor lenders, they have various credit reference agencies that they work with, such as Experian or Equifax or Core Credit. Now, when someone has repaid successfully, the information is automatically fed back to a credit reference agency, and then it shows on your credit file. But if you don't repay on time, then the information will be sent, and this may actually cause your credit score to go down. It may have a negative impact, and this is obviously something that neither parties wants. So the things to consider before agreeing to be a guarantor: is the borrower, do they have bad credit? Are they using this to boost their credit score? Well, if so, then that is obviously a good reason to be a guarantor, because they want to demonstrate that they're creditworthy, and if they pay on time, then they're actually able to better their credit rating, and then this will allow them to obtain finance and other forms of credit in the future, making them more self-sufficient, and then they won't need a guarantor in the future. But if the borrower needs the money for like a special expense or a special purchase like an engagement ring, the guarantor needs to consider, well, is this something that they need to save up for rather than actually getting me involved? There are things like jewellery which maybe isn't a necessity, but there are some things like maybe a funeral where the person does need money very quickly, or it's a broken car and they do need the money quickly. In that case, that would be maybe a good reason to be a guarantor. Another thing to consider as the guarantor is whether the borrower has any other alternatives to using a guarantor loan. Do they belong to a credit union because of their work, or can they apply for a 0% credit card? Can they even sell things like old clothes, CDs or jewellery on eBay or at a car boot sale in order to get the money they need? And probably the last and most important thing to consider is, if the borrower defaults on their loan and you have to pay for it, will they actually pay you back? You don't want to be a few £100s out of pocket, but will they pay you back? Do they have a steady flow of income? Do you have a close relationship where you trust them? And these are obviously very important things to consider. And the final thing we suggest is, if you want to read more information about being a guarantor, we have a link here at the bottom of the page from the Money Advice Service, who provide some fantastic information.